A cover-up exposed. I'm your host, Steve Van Metre, and thanks for joining me today. In our show today, it's a bombshell report as one expert just exposed a massive government cover-up that mounts into the billions of dollars. This is one so big you won't believe it. Of course, as you expect, the government's denying all of it. We'll give you the evidence and you make the decision. Now, let's over to Bloomberg, where he picked the story up with a headline, as Yellen rejects Rubini claim of manipulation in treasuries, and this is everything to do with the economy, because of course, as we know, Janet Yellen is the Treasury Secretary. She's in charge of government debt. And right now, with the economy slowing down, she's going to do everything she can to keep the party that put her in power in charge. In an interview with Bloomberg News, Yellen said Rubini's argument laid out in a paper published on Tuesday suggests a strategy that is intended to ease financial conditions, and I can assure you 100%, Ms. Yellen said, that there is no such strategy. We have never, ever discussed anything of the sort, but yet the evidence suggests otherwise, and this is manipulation into the billions of dollars done perhaps deliberately, as I'll show you, to keep the economy afloat until the elections. The paper echoed a line of attack that several Republican politicians have recently leveled at Yellen. It highlights a move by the Treasury in November to temper a ramp-up in issuance of longer-term securities, relying instead on more short-dated bills. They argue this was done to hold down long-term borrowing costs, aiding the economy in the run-up to the November elections. And I want you to think how this is the exact opposite of what's happening in China. You know, they're concerned that interest rates on the long end of the curve are going down. So what is the Chinese government doing? Issuing an excess amount of long-term debt, trying to bring long-term interest rates up. So here you see the opposite happening in the U.S., where there is now evidence suggesting that Janet Yellen deliberately issued less long-term debt than normal, perhaps to keep long-term interest rates down and the economy afloat. But something that else is floating up higher, well, that is, of course, our subscribers' accounts. Look at this. Here you can see back on July 11th, we recommended through our CTA Timer Pro report that our subscribers buy ITB at market open. As of Friday's close, they're up a whopping 15.65%. And here's the best part. This is totally duplicatable. I'll show you why. Because what we do with our CTA Timer Pro is we look at machine positioning across a wide range of securities every day, and we look for them to get into deep short positions, and when price rallies against them, that means the machines have to short cover and buy. That flags on our reports, and we tell our subscribers exactly which trades we think they should do, how to do them, and give them stop loss levels. But maybe you don't want to just beat the machines. Maybe you like to trade the technicals. We've got a report for that too. It's called Momentum Timer Pro, because we look at momentum over different scales, such as a 1, 3, and 6 month period, and when we see large pullbacks in momentum and then a change as momentum rallies, well, our report flags that too. Here's the best part. You get the daily report. You pick the one you want to sign up for, maybe both. You get the report. You get every tradable signal, and I review each and every one of them to tell you what I think are the best trades you should do. I give you the stop loss levels. I track the trades and returns, and we give you a weekly update every Saturday on the stop loss levels. You can absolutely 100% duplicate what we're doing, and the best part is we give you 30 days to do it. And here you can see, here's the two reports. Here's all the data that I give our subscribers each and every day on the trades to make it so that you can actually benefit. I know my buddies sell stuff, but you can never duplicate the trades. Ours, you can, and make a ton of money doing it. And Rubini and his co-author, Stephen Moran, who served in the Treasury under President Donald Trump, estimated that the Treasury's move last fall lowered 10-year Treasury yields by a quarter of a percentage point, roughly equivalent to the impact of a full percentage point reduction in the Federal Reserve's benchmark rate. And this is an issue because what they're suggesting is that yields on the intermediate and long end of the curve should be higher than they are now, but due to Janet Yellen's direct intervention in the bond market, they're not. The Treasury is dynamically managing financial conditions and through them the economy, usurping core functions of the Federal Reserve. This was from Moran and Rubini in their paper published by Hudson Bay Capital, indicating that yes, this is all about the economy. This is all about the election. And the problem that they see is that if interest rates were higher, as they should have been, well, the economic damage from them would be far more severe than it is now. Yellen, knowing that, deliberately issued less securities, and in fact what she did do is issue more Treasury bills, and this is the issue they have. You see these two red lines across the horizon. This is the recommended target range that the Treasury issues T-bills, and it's roughly 15 to 20% of total outstanding marketable debt. But for some reason, in 2023, all of a sudden around November, T-bill issuance goes up. Now you're saying, wait a minute, what happened back here? Well, this was a pandemic in March of 2020. Government issued a massive amount of T-bills. There was clearly no pandemic here. The evidence suggests that something wasn't right, because what was the reason for them doing this? Well, as I'm about to show you, it has everything to do with the economy, and then you can weigh in the comments. Do you think this was direct manipulation by the U.S. Treasury headed by Janet Yellen, or was this just, of course, as you're going to see, her saying they're doing what they need to do to get debt issued to the public? And here you can see the evidence that higher interest rates on the intermediate and long end of the curve do have economic repercussions. You'll notice we have 10-year Treasury yields in red against advanced retail sales in blue. That one on a year-on-year rate of change. And what you can see is there's periods where higher interest rates just cannot be absorbed or handled by the economy, and you see then a downward move in retail sales. This happens in the 90s. You see it happening again toward the late 90s, and then going into 2000s again, rates go higher, and of course the economy can't handle that. Retail sales go down, and the big issue here is, why do retail sales matter? Well, it matters for the labor market. Of course, this is the big tenet of the Democratic Party right now, saying the economy is booming on the back of a strong labor market. Well, Janet Yellen may actually want to see it stay strong and do what she can to keep it there. And that involves consumer spending. You can see here around 2006, rates go up. The economy just can't absorb it. Again, around 2010, 2013, 2018, you see these effects of higher rates, and you look at currently around 2022, rates are really getting too hot for the economy, and what happens? Advanced retail sales heads down and is likely to head even lower. And we can look at this at the housing market. Of course, this is something that Janet Yellen missed back when she was, of course, in charge of the San Francisco Fed. She didn't even see the housing crisis unwinding in her home backyard. But look at what's having the effect of rates in the housing market, which we know employs a lot of people. You can see going back into the late 80s, rates on 10 years were just too high. And here you see new privately owned housing starts. Well, they just tumbled down. This happens when there isn't enough buyers. You see it repeats again in the 90s. Rates go up, housing starts down. Of course, that means people losing their job. Happens again in 1996, happens right around the peak of 2000, and then again heading into the big global financial crisis where the housing market implodes. You see rates are rising, housing starts are there, demand goes away, and then everything plunges. And here we're seeing it again. Housing starts are coming down. As they continue to fall, there's less demand for labor. The economy weakens, and she's saying, hey, wait a minute, maybe rates here are just too high. She knows the Fed isn't going to cut, but what can she do to bring the long end rate down even a little bit? Well, it's about changing how the issuance is done. And it does have effects because it steamrolls across into manufacturers' new orders. When the housing market goes, demand goes, the labor market goes. You can see here again higher yields in red against manufacturers' new orders of durable goods in blue. That's shown on a year-over-year rate of change. That declines because of a decrease in demand. Happens again around 2006, 2010, 2013. Here you see it going into the pandemic. This economy, as we know, was already slowing down ahead of of that. And now look, we see a huge drop in new order growth. And that means, of course, rates now too high. It's choking out the economy. And we see it even affecting the labor market as we look at total compensation growth, because when demand goes down, well, that means employers do not need to give out as much in pay raises. They don't need to dole out as many hours to work. And what we see in form of total compensation, that's shown in blue as average hourly earnings of production and non-supervisory employees multiplied by the average weekly hours they work. And here you see on a year-over-year rate change, high interest rates, demand goes, that hits the labor market, happens again in the 90s, happens again in the late 90s. Then you see here going into the dot-com bubble, rates rise, total compensation growth slows, happens again just after the recession happened, and then going into the global financial crisis, almost causing a double-dip recession here after the GFC, going into the pandemic. And look, now you can see total compensation growth going right down in line with rising interest rates. And this is a big issue for a debt-based economy, because what you need is the issuance of new debt. And how do you get that? Well, rates need to be at a level where people want to borrow, banks want to lend, and that actually creates money into the economy, creates economic growth. Again, the issue here is Janet Yellen is the Treasury chief, Treasury secretary, former Fed chief. She knows their playbook. She helped write it. She knows they're not going to cut, but knows the economy is weakening at a quick pace. And Frost, the Treasury Assistant Secretary for Financial Markets, in a detailed speech this month, stressed that the department issues debt in a regular and predictable fashion as part of our strategy to borrow at the lowest cost over time. Do you believe this, or do you believe that Janet Yellen was indeed manipulating billions of dollars in Treasury issuance to keep the economy afloat? Of course, remember, she was appointed under President Biden. Was this all a deliberate attempt to help the party that put her in charge, keep him in power? Weigh in the comments. Would love to hear, because let me show you the effect of higher interest rates is having right now on the economy, providing some evidence she did know exactly what she was doing. As tighter loan terms are plunging retailers deeper into distress. In the troubled world of junk-related retailers, pressure from providers of senior-most loans, lines of credit that are backed by assets including inventory, contributed to liquidity crises this week at Conn's and earlier this year at Express. Both retailers spiraled into bankruptcy amid demands that they set aside extra cash to cover potential losses on that debt. And this is, of course, being demanded by the banks who are saying, wait a minute, we're not sure you're going to be able to pay your bills. You need to set excess money aside. But it's just a function of what happens when a debt-based economy doesn't issue enough debt. There isn't enough new money to pay on the existing debt and hit the growth targets. So what we're seeing at Conn's and Express is not surprising. It's what happens when you constrict the creation of credit. And similar requirements have contributed to the struggles of retailer LL Flooring, which, squeezed by an ebbing home renovations, well, based on where housing starts are going, it's only going to get worse, has scrambled to comply with the terms of its ABL. That follows a bankruptcy filing last year of Bed Bath & Beyond, which failed to meet demands and defaulted on the same type of loan. And what we're seeing here is a setup for a massive crisis that we're going to see debt defaults all across the U.S. economy. But the pressure begins with banks subject to rules aimed at curbing systematic financial risk. The latest step in a global effort known as Basel III will begin next year and require the 8 biggest U.S. banks to increase the capital pools they must maintain to offset potential losses on illiquid loans such as asset-based credit facilities. Of course, those are one of the issues here, and this could be solved by lower interest rates in a big way. But the fact that Janet Yellen's trying to lower interest rates, she actually knows what the real problem is, and that's called an inverted yield curve, because when the Fed inverts the yield curve by raising short-term rates higher than market expectations, what happens, you see here in red, we have the 10-year, 2-year, and when it's below the horizontal black line, it means 2-year yields are higher than 10-year, and that is not normal at all, suggesting that if the Fed was not manipulating the market itself, the 2-year yields would be lower than 10-year. And what happens happens, as you see in blue, the net percentage of domestic banks tightening standards for commercial industrial loans to firms of all sizes, as banks are unable to make money on the interest rate spread because they borrow at the short end of the curve and lend at the long end. So what it means here is they would lose money on the interest rate spread. They tighten standards, make it more difficult to people to borrow, and in turn that constricts the creation of credit. But Janet Yellen's solution is, well, we'll just issue less long-term debt. That should take some pressure off the economy, but it doesn't cause the banks to lend because it isn't enough. Rates need to come down substantially, which she doesn't have the power to do. And here you can see, as we now look at the 10-year Treasury yield against the net percentage of domestic banks tightening standards for firms of all sizes, what you can see is that as banks tighten, rates tend to go down. This is one time banks have tightened, and the market says, and the Fed says, not a chance, suggesting that as the yield curve uninverts and rates come down at some point, banks will further tighten lending standards, leading to an absolute crash in intermediate and long-term yields because the economy will be desperate for new money, and the only way you get it is to have the creation of new money backed by lending. Rates will need to fall substantially. The challenge is, if you have a lot of people on unemployment, a lot of businesses filing for bankruptcy, there's no chance that they're going to be able to get credit at all. And the Columbus, Ohio-based chain that needs more money despite receiving a loan earlier this year is up for $200 million as Big Lots suffered from years of same-store sales declines. Its stores number almost 1,400 as of May. For the 3 months that ended May 4th, the company saw its net sales drop a whopping 10.2%, or about just over $1 billion compared to a year earlier. The CEO cited challenging consumer environment and strained budgets in his first quarter earnings call. The company reported a net loss of $205 million. So you have to expect that Janet Yellen is well aware of what's going on in the economy, and everything is playing out just as it should. Because when you, again, constrict the creation of credit, businesses that need it can't get it, consumers that want it can't get it, and they don't spend, and next thing you know, you set the stages for the next financial crisis. And we could see that flowing over into auto dealers. As new car incentives soar a whopping 53% amid rising inventories and lackluster demand, which are hinting at a massive downturn. Auto dealers are seeing an uptick in inventory while many consumers remain on the sidelines, possibly because they don't have money and they don't have access to credit. Deterred by the toxic combination of high interest rates and elevated inflation, well, that's what they say, but the reality is the labor market here is slowing. We saw that in the total compensation data. They can't get access to credit, so why would you spend if you see the economy slowing, you see business actually declining? People are not going to go out and spend big money on expensive cars. In response to what seems to be a more pronounced slowdown, dealers are slashing prices and increasing incentives to stimulate demand this summer. In a new report from Financial Times citing data from Motor Intelligence with manufacturers such as Hyundai, General Motors, and Volkswagen, shows that average incentive packages to sweeten the deal jumped a whopping 53% in June compared with the same month last year. And anytime manufacturers and dealers increase incentives such as offering low interest rates, cash back, and price cuts to entice consumers, it's usually an ominous sign of alarming demand problem, one that we know has everything to do with high interest rates that Janet Yellen cannot do enough to bring down. And even though inventory levels are not back to pre-COVID levels, no dealer wants to sit on many unsold vehicles and will continue to offer incentives. The higher for longer interest rate environment that will likely be confirmed next week continues through the end of the year. This could seriously pressure new auto prices. But as soon as the Federal Reserve begins cutting, which according to rate traders could be as early as September, but mind you, a 0.25% cut isn't going to do anything here. It's not going to change the fact that interest rates are too high. The notion that a 0.25% cut is going to change the whole economic landscape, not going to happen at all. And of course, what we know that they need demand, and that needs to soak up the supply in a very quick time. But look at this. There's a perfect storm brewing in the auto market as the latest data shows auto repossessions are soaring, which is just more evidence that there isn't enough money to keep the economy afloat. Remember, when you constrict the creation of credit, eventually the music stops. You find out that not just businesses, it's consumers, it's across the board. People can't pay on their debt as auto repossessions rise is a strong indicator we're close to an inflection point that Janet Yellen doesn't have the power to stop. And look at this, Boeing gone, as we see durable goods and new orders outright crash as the headline print for the preliminary June data was a disaster, dropping a whopping 6.6% month over month, which dragged good orders down. And here you can see durable goods new orders month over month in green. You see the crash down here, and that is shown in red, going negative against the new orders year over year rate of change, also in decline. But look at this. Did it have something to do with the Boeing effect? It did, as non-defense aircraft and parts new orders dropped somehow a whopping 127.2%, suggesting again all the evidence is mounting. Interest rates are too high. The U.S. economy is struggling with a lack of money, and at some very soon point we're going to hit that inflection point. It's all going to come crumbling down, and this time Janet Yellen's not at the helm of the Federal Reserve, but doing potentially everything she can at the Treasury. What do you believe? Do you think this was direct manipulation by Miss Yellen, or was it just as a matter of them doing their job? Weigh in the comments below. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.